Hello everyone, welcome to my channel. Uh, I am back with a new video today. Today we will be discussing about the fundamentals of AML and KYC. I hope most of you have already heard about these two terms, AML and KYC. AML is your basically anti-money laundering, and KYC is your know your customer. These two terms are very significant and very important from the banking point of view. uh, um, to tell about the AML and KYC. AML is about stopping entering bad money into the banking system, and KYC is about knowing the customer well enough to detect what is normal and what is suspicious from a banking point of view. Um, this video is going to be useful for the beginners, for the business analysts, testers, banking professionals, compliance team members, and anyone aspiring to go for AML KYC domain. AML KYC domain is a very interesting domain from the regulatory point of view. Okay, now that we know that what the topic is going to be for today, let's understand first why AML and KYC matter so much for banks. So you must have heard about this financial crime. So financial crime is not only a compliance issue today in the banking world. Many beginners think that AML is only about regulators and penalties, but in reality, anti-money laundering or AML is about trust, risk, governance, reputation, and social responsibility. Um, let's just follow this particular flow on the slide. So first, there is criminal money. So this could come from your criminal activities, basically, like drug trafficking, fraud, corruption, tax evasion, human trafficking, cybercrime, or sanctions violation. Then the money coming out of this criminal source, the money tries to enter into the banking channels. So these channels could be your bank accounts, cash deposits, trade finance, digital platforms, or cross-border transfer. Now, bank must have the control on its system, and this control includes the KYC, screening, transaction monitoring, investigation, and regulatory reporting. The final outcome of this particular process is to protection of the bank, protection of the customers, protection of the system. The bank protects itself, its customers, regulators, and the society. In layman words, AML KYC is like a bank saying, before we allow money to move freely, we need to understand who is moving it, why it is moving, and whether the behavior makes sense. From a regulatory perspective, banks must identify, assess, monitor, and report the suspicious activity. From a risk perspective, failure can lead to huge fines, reputational damage, business restrictions, and even criminal exposure. And from a business perspective, that is from the bank's perspective, good KYC helps the bank understand customers better and reduce the operational risk. Okay. To understand the AML properly, we need first to understand the crime AML is trying to prevent, and that is called money laundering. So money laundering basically means taking money earned from illegal activities and making it appear as if it has come from a legitimate source. In simple words, dirty money goes through a process and comes out looking clean. Let's take a small example. Suppose a criminal earns 50 lakhs rupees in cash from an illegal activity. The criminal cannot simply walk into the bank and say, "Hey, please deposit this money," without any questions being asked to me. Now, they would immediately raise suspicion from the banker's point of view. So, the criminal needs a story. Maybe the money should be shown as a business income. Maybe it should be passed through multiple accounts in smaller values. Maybe it should be used to buy property. Maybe it should be routed through cell companies. So, the core objective is to hide four things basically. One is the source, the illegal source. Uh, Second is the ownership, the real owner, then movement of funds, and the actual purpose of the fund. Now, money laundering, think of it like washing a stain shirt. So the original stain is the crime. The laundering process tries to remove the visible stain so that the shirt looks clean. But the bank's job is to detect the stain before it disappears. However, banks may unknowingly process deposits, transfer, investments, card payments, cash transaction, or any trade transaction linked to the crime. That is why AML controls are very important. And money laundering is not just cash. It can happen through your digital payments, trade finance, crypto, real estate, securities, prepaid cards, and cross border transfer. And that's why you must have already observed that there are so many restrictions when we do any transactions. There are so many controls imposed on us just to prevent the money laundering. Now that we know what money laundering means, let us understand the classic three-stage model. So there are three stages in doing the money laundering. First is placement. Placement means money enters into the financial system. So this is where dirty money or illegal money is introduced into the financial system. For example, cash is deposited into bank accounts. Cash is used to buy high value goods, or cash is split into smaller deposits. So the placement gives the entry point. This is often the most detectable stage because cash or unusual deposits are entering the system. So if someone with a modest income suddenly deposits huge cash amounts, the bank must ask questions that what is the source of this money. Second is layering. So layering means money is moved around to hide the trail. So this is where criminals create confusion. Money is transferred across multiple accounts, companies, countries, currencies, or financial products. Think of it like adding many layers of fog between the crime and the money. The goal is to make investigations tired, confused, and slightly irritated. In the real banking world, layering may involve, shell companies, cross-border transactions, trade-based money laundering, crypto conversions, or frequent movement of funds within connected accounts. Third stage is the integration. Integration means money comes back looking legitimate. So this is when the money comes back into the economy looking legal. It may appear as proper investment, business profit, consultancy income, loan repayment, luxury assets, or foreign investment. This is the hardest stage to spot because the money now looks clean. The money has already got mixed into the economy. It has a story. The money has a story. So now when you work on the transaction monitoring or ML systems and scenarios, rules and scenarios often you will often work on the rules and scenarios, and rules and scenarios often map back to these three stages. So cash threshold rules may detect your placement. Complex fund movement rules may detect layering. Then high value purses or investment patterns may detect your integration. Money laundering starts with dirty money, but there's another term called terrorist financing, which is a bit different. Let's understand terrorist financing as well. So in money laundering, the source of income or the source of fund is usually illegal, but in case of terrorist financing, the source may be legal. The money may come from a salary or donation, um, legal charity collection, business income, or some small personal transfers. The problem is not where the money has come from. The problem is where the money is going to, the movement of the money, and what it will be used for. To put it simply, terrorist financing is about funding terrorist activities or extremist operations. This is similar to clean-looking water bottle may still be used to carry poison. The bottle looks fine. The danger is in the purpose. The movement of funds may involve small transfers, informal networks, intermediaries, cash couriers, charities, or hawala channels. Now, why is it hard to detect? Because the amounts can be very small. The transaction amounts can be very small. One transfer of say $200 or 20,000 rupees may not look suspicious, but repeated transfers, risky destinations, unusual beneficiaries, and unusual patterns may create concern. This is why banks do not look only at the amount; they look at the customer behavior, transaction pattern, geography, counterparty, occupation, frequency, and purpose. You may think that only large transactions are risky, but that is not always true. Small transaction can also be risky when the pattern or destination is suspicious. Now let's compare the money laundering with the terrorist financing side by side. Money laundering usually starts with the illegal proceeds. illegal source. The criminal already has dirty money and wants it to make legal. That's the sole purpose of money laundering. In money laundering, investigators often follow the money backward to basically track the origin. They ask where this money come from, what was the original crime, who is the real owner. But in terrorist financing may start with a legal fund. The funds may come from salary, donation, charity, or business income. But the purpose is illegal. So in the terrorist financing, investigators often follow the money forward. They ask where is the money going, who is going to receive it, what will that money be used for. And also, money laundering often involves large amount, whereas terrorist financing involves a small amount to large amount as well. Money laundering hides the past. Basically, money laundering hides the past, and transaction financing hides the future. So in the banking world, this distinction affects the monitoring rules. For money laundering, rules may focus on unexplained wealth, cash deposits, complex transfer, shell companies, and unusual source of funds. For terrorist financing, rules may focus on the high-risk geographies, small repeated transfers, risky counterparties, charities, and the behavioral patterns. Okay, now that we understood the crime side, let's move to the customer side. That is KYC. KYC basically stands for know your customer. KYC stands for know your customer, and this term is quite understandable. Know your customer. Basically, you want to know your customer before you build a relationship with the customer. The KYC is the process a bank uses to verify the customers, understand their activities, and assess the risk of having of building relationship with a customer. Now, many people think KYC means your document collection, but that is document collection is just one of the part. KYC basically answers three questions: who, what, and what risk. So, who means who is the customer basically? Is the person or is the customer real? Are the documents valid? Is the identity verified? So that comes out of the who. And second is what. So that basically asks what is the purpose of banking relationship? Why does the customer need the account? What type of activity is expected? Is it a salary account? Is it a business account? Is it a trade account? Is this payment going to be? Is this a high value international payment? So that's the query that basically comes. That basically asks another what and what risk. So what risk does this customer bring? Are they politically exposed? Are they from a high risk country? Is the business cash intensive? Is the ownership structure complex? So KYC basically helps the bank define what normal behavior should look like for the customer. For example, if a small grocery shop deposits cash daily, that may be normal. But if a salaried employee suddenly starts, if a salaried employee having a monthly income of 50,000 rupees suddenly starts receiving dozens of international business payments, that may need review from the bank side. Um, KYC basically includes processes like customer due diligence, enhanced due diligence, customer risk rating, beneficial ownership check, screening, periodic review, and ongoing monitoring. And KYC is not a one-time process basically. KYC is not a one-time process. It continues through the customer relationship. Customer risk can change anytime. So that's why banks keep doing the KYC basically KYC check on a regular basis. Now let's zoom out and understand the scale of the financial crime uh, from the global context. As per the report, an estimate of 2 to 5% of total global GDP is laundered annually, which is, if you calculate, I think current total GDP globally is 136 trillion USD. Yeah, I think it is 136 trillion USD currently, and if we even calculate 2% of it, it is more than $2 trillion. So this number is very huge. Over $2 trillion per year. That's a huge number. That is not a pocket money. That's an entire shadow economy moving through the financial systems. And this figure is even more than GDPs of many countries. So to control the financial crime, banks need to categorize. Banks need to counter multiple categories. For example, money laundering, terrorist financing, fraud, tax evasion, sanction violation, bribery, corruption, and proceeds from human trafficking or drug trafficking. Now, why do banks carry such heavy obligations? Because criminals needs access to the financial system. They need bank accounts, payments, cards, trade channels, foreign exchange, investment accounts, loans, and sometimes sell companies. So banks become the control points. Banks are the carrier of the value. So banks become the control point. They can identify the suspicious behavior. They can block the transaction. They can investigate the alerts. They can report suspicious activity, and sometimes exit a risky relationship as well. In layman terms, banks are like toll gates on the financial highway. Not every vehicle is stopped, but suspicious vehicles must be checked. This is why AML systems must be connected with customer data, transaction data, screening data, cash management, and regulatory reporting. Now let's make this practical. Now let make this practical with some real banking and compliance examples. Let's go with example one. This is an example of smurfing. It is also called structuring. Suppose a criminal network earns 2 crore weekly in cash. Now depositing 2 crore rupees directly into one account will raise question. So instead, what the criminal will do is they use, say for example, 25 people. They recruit 25 people to deposit smaller amounts like 8 lakhs rupees in each of the account across different branches. Now, this is called structuring because the deposits are deliberately structured to avoid detection thresholds. This usually belongs to the placement stage because cash is entering into the banking system. In simple words, instead of one big suspicious deposit, criminals create many smaller deposits to look this particular transaction normal. Second example is real estate integration. Suppose a politician receives 50 crore rupees in cash. The funds have to move through multiple jurisdictions and sell companies such as Mauritius, Singapore, and then return as a foreign investment to buy property. This involves your layering and integration. This particular comes under an integration stage. So the layering creates complexity, and the integration makes the money appear legitimate through the property investment. Now think of it like sending money on a world tour and bringing it back wearing a shoe. Third example is terrorist financing. A grocery store owner sends a small regular amounts to a relative abroad. Individually, say he is sending 200 to 300 pounds. This may not look suspicious, but if the funds are channeled through informal networks like Hawala networks and used for extremist activity, the risk is not just amount. The risk is pattern and the purpose. Now, looking at these three examples, we can say AML monitoring is not only about uh, single transaction. It is behavior over time. Now let's. This is one of the most important slide in the AML. While going through the AML concepts, this basically talks about the end-to-end life cycle for a AML uh, domain from a banking perspective. Let's try to understand how AML compliance works inside a bank, um, not just from the compliance policy point of view, but from a banking system and the process perspective. So the life cycle basically starts when a customer wants to open an account. This is where the life cycle basically starts. Or the customer may also establish a banking relationship. So at this stage, the bank collects the customer information such as name, date of birth, address, ID documents, occupation, business details, source of funds, and purpose of relationship. The bank is trying to answer basically three questions here. So, who is the customer? Why do they want to bank with us? Does anything look risky? This is where KYC and CDD happen. KYC basically KYC means know your customer, and CDD means customer due diligence. And for normal customers, standard due diligence may be enough, but for high risk customers, the bank has to perform EDD, and EDD means enhanced due diligence. From a system point of view, this data is captured in the KYC or the onboarding system and may also flow into the core banking system. Now, once the customer details are collected in this stage, the bank needs to perform a risk assessment on the customer. The system or the risk Engine checks factors such as customer type, country, occupation, product, channel, expected transaction behavior, politically exposed person status, and business activity. Based on this factor, the customer is assigned a risk rating. It may be a low, it may be a medium, or it may be high. This risk rating is very important because it decides how the customer must be reviewed and how closely their transactions should be monitored. Next comes the screening. Once the risk assessment is completed, next comes the screening. The bank needs to check the customer, the related parties, the directors, authorized signatories, and beneficial owners against sanctions lists like PEP lists, watch lists, and adverse media sources. The bank is checking, is this person or entity linked to that linked to any sanctions or political exposure, negative news, or non-financial crime risk. The screening can happen in real time, or it can also happen in batch mode when the watch lists are updated. If there is a match, if there is a match, the system may create a screening alert, may need to create a screening alert, and that alert needs to be reviewed. After KYC, after risk rating and screening check are completed, the bank decides whether to approve or reject the onboarding request. If approved, the account is activated. The account is activated, and account is activated in a core banking system. But this is not just a simple account opening activity. The system should capture approval evidence, user details, timestamps, risk category, and any controls or restrictions applied to that account. For example, a high risk customer may be onboarded, but with additional monitoring controls. Once the account is activated, or once the account is active, the customer will definitely do start doing transaction. Right. This is where the transaction monitoring comes to the picture. The transaction monitoring system, or TMS, continuously check the customer transaction. Whatever transaction customer initiates or processes, every transaction goes through the transaction monitoring system. It is also applicable to our transaction as well. It may monitor your cash deposits, your fund transfers, international payments, card transactions, any type of payments that do not match a customer profile. So TMS keep checking, is this customer behavior as expected. For example, if a salaried customer suddenly starts receiving large cash deposits every day, the system may detect it as unusual, and that's get flagged in the transaction monitoring system. When the monitoring rules or analytical models detect unusual activity, an alert is generated. The alert is not your proof of crime, it is only a signal that something needs to be reviewed. The system creates an alert with transaction details, customer profile, rule name, risk score, and reason for the trigger. Then the alert goes into the queue management system and is assigned to an analyst or investigation team. Alert does not mean suspicious activity is confirmed. Alert is just to make the team aware or alert that, hey, look, here is something you need to investigate. Now the alert moves into the cash management system or cash management stage. An ML analyst reviews the customer profile, transaction history, KYC documents, informations, expected activity, previous alerts, supporting documents, and any external information. The analyst may ask questions such as, does this transaction match the customer's non-business? Is there a reasonable explanation? Is there a pattern across multiple accounts? If the case is simple, level 1 may close it. Level 1 analyst may close it. But if it is more serious, it may move to level 2 analyst or level 3 stage for further review. From a system point of view, every action, comment, document, and decision must be captured in the case management system. Now, after investigation, the analyst or compliance officer makes a disposition decision. There can be different outcomes. The alert may be closed as a false positive. It may be closed as no suspicion. It may be escalated for further review. Or if the suspicion is confirmed, the bank may file SAR, STR, CTR, depending on the jurisdiction or country and the reporting obligation. Um, Now, you may be wondering what is SAR, STR. This is just report actually. SAR means suspicious activity report. Suspicious activity report. STR basically means suspicious transaction report. So this is an important point. Not every alert becomes a regulatory report. Only cases that meet reporting criteria are filed. Now, if the suspicion is confirmed, the bank has to submit the required report to the regulator or the country's financial intelligence unit, which means it could be your uh, it could vary depending upon the country. Now, depending upon the country, this may be your SAR, STR, CTR. Like I said, SAR means your suspicious activity report, STR means suspicious transaction report, CTR means cash transaction report. The reporting system must ensure that the filing is submitted in the correct format within the required timeline and with proper acknowledgement. And this involves your data mapping, report fields, workflow approvals, validations, submissions, and audit trail. Now, as so, this is how the end-to-end flow of a particular AML, I mean, the whole AML compliance looks like in the banking system. Now, look at this middle layer of this diagram. There is a core data and thus where the core data system involved. This is very important from banking system point of view because you can see the core banking system. Core banking system basically holds your customer accounts and a transaction. The KYC system basically manages the onboarding and due diligence. Screening solution checks the sanctions, PEP, and the adverse media. Transaction monitoring, as we have already said, it generates a system alerts. Then the cash management system is where uh, the alerts get logged into, and we have the customer risk rating system that calculates the risk score, the regulatory reporting system where the files are reported, and the data warehouse system where the data are data are basically analyzed and reported. You must understand how data moves between these systems. The next layer is your governance and the controls. So ML compliance is not only about systems. The bank also needs policies, procedures, access controls, segregation of duties, audit logs, quality assurance, and so on. The bank must prove that the ML process is controlled, reviewed, and it is auditable. You know, then comes continuous feedback and improvement. So ML lifecycle does not end after reporting. The bank needs to continuously improve their ML program, right? They monitor the alert quality. They need to reduce the false positive. Then they need to update the rules, improve data quality, train the analysts, and review customer risk and controls periodically. So ML is a continuous improvement cycle. Then we have the final outcome. The final outcome of this entire life cycle is not just filing reports to the regulators. The bigger purpose is to prevent the financial crime, protect the bank's reputation, comply with the regulations, maintain customer trust, and support sustainable business. So AML is not a back office formality; it's a major risk management function inside the banking. Okay, now let's understand one very important point: system touch points. So AML and KYC are not handled by one single system sitting in a corner of the bank, as we have seen in the previous slide when we were discussing about the ML lifecycle. So in reality, ML or KYC is basically delivered through interconnected systems. Every system plays a different instrument, but together they help the bank identify the customer, monitor risk, detect suspicious activity, investigate alerts, and report to the regulators. Let's go one by one. First, we have the core banking system. The, in the current IT world, these are the prominent vendors who provide the core banking system. For example, Temenos, Finacle, FIS, and the core banking system is the heart of the bank. It stores the customer data, transaction data, balances, deposits, withdrawals, and other banking activity. And for ML KYC, core banking system basically provides the raw customer and transaction data. And without this data, ML systems are will be blind. Next comes the KYC and onboarding system. Examples include your Pega, FPN, Encino. This is where the customer journey starts. And when the customer basically opens an account, submit document, files forms, or goes through approval workflows, this system, KYC onboarding system, captures and manages the information. Then we have the screening system, such as Ficosoft, WorldCheck, Equity. This system check whether the customer is linked to any sanctions, politically exposed persons, adverse media, or other watch list. After that comes the transaction monitoring system. Examples are your Actimize, Mantas, Nice, Actimize. Um, this system basically provide continuously check customer transactions and against the rules and machine learning models. Now, once an alert is generated, it cannot just sit there. This is where the case management system comes to the picture. Examples are again your Actimize, Case Manager, APM, Salesforce. The systems basically help investigators review the alerts, collect evidence, add comments, make decisions, and close the case with a proper disposition or proper decision. Next is your regulatory reporting. Examples are your FinCEN, GoAML, FinScan. So if bank finds suspicious activity, it may need to submit SAR, STR, CTR reports. Then we have the data warehouse, such as Hadoop, Snowflake, Oracle. This system basically stores aggregated data from multiple sources. Okay, now systems are powerful only when the data inside them is complete and reliable. So let's move to critical data elements, critical AML KYC data elements. First is your customer identity. This includes a name, DOB, date of birth, address, ID numbers. If identity is wrong, screening and monitoring will fail. Screening and monitoring will fail. Second is beneficial ownership. For companies, the bank must identify who ultimately owns or controls the entity. This is very important because criminals may hide beyond the complex company structures. Third is transactional data. This includes the amount, currency, counterparty, channel, frequency, transaction types. Fourth is risk rating. This includes the customer risk score, risk drivers, the rationale behind the risk score. The bank must not only know the score, but also why the score was assigned, and that is what we call a rationale. Fifth is alert history, previous alerts, investigation notes, dispositions help analysts understand behavior over time. Sixth is your records, SAR filing record or STR filing record. These are regulatory reports and submission histories. Seven is screening results. This includes your PEP, matches, sanction, hates, adverse media, and match decisions. So these data elements are the fuel of the AML engine. If the fuel is contaminated, the engine will fail. Similarly, if AML data is incomplete, any of these seven is incomplete or inaccurate, alerts may be missed, false positive may increase, and investigations would become weak. Now, even when the systems are available, data quality issues can create serious control failures. Let's discuss the common problems. First is duplicate customer records. The same person or the entity may have multiple customer number or customer IDs. One account may show salary income. Another account may show business transaction, and another may show cash deposit. So if the system does not connect them, monitoring sees only the fragments. In simple words, the bank sees one pictures instead of one complete movie. Second is the inconsistent names. For example, we have Muhammad with different alphabets or different way of writing. Muhammad, Muhammad. So they may refer to the same person, but poor matching logic may treat them differently. So this affects screening because sanctions and PEP matching depends heavily on the name quality. Third is missing or expired IDs. So if KYC documents are incomplete or outdated or invalid, the bank cannot properly verify the customer. Fourth is your stale customer data. So all address, all occupation, in all income or outdated business activity can mislead risk assessment. That's why the banks need to keep updating the customer information time by time. Fifth is incomplete ultimate beneficial owner chain. For companies, hidden ownership is a major risk. If the bank cannot identify the ultimate beneficial owner, the true controller may remain hidden. Sixth is the foreign exchange inconsistency. So if the currency foreign exchange inconsistencies. So if the currency conversion is inconsistent, threshold monitoring and analytics can become distorted. So data quality defects become control failures when alerts are missed, duplicated, or wrongly prioritized. In AML KYC projects, data quality is not just a technical issue; it's a compliance control issue. So, and with this, we come to the end of this video. In this video, we have covered the foundations of or fundamentals of AML KYC. Hope you are able to grasp some concepts out of it. Please hit the like button. If you really like this video, do hit the subscribe button to remain updated with the upcoming videos on the banking domain and some other technology related stuff. With this, I will see you in the next video. Till then, bye.